I think what we could experience is a longer and grindier type of inflation. Now, obviously, things like acute energy shortages or war or, you know, tail risks can always give you crazy numbers.
In today's video, Lyn Alden, an investment strategist and macroeconomist, discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
What does inflation do over the course of the next decade or so? Is it persistently higher, or have we really seen the peak?
So I think in the near term, disinflation is still winning, but
Mm.
in part that battle's being prolonged. I think because basically you have on one hand you are squeezing the private sector, but on the other hand you are actually exacerbating the public sector. And
Mm.
so, part of why a lot of these recession forecasts and kind of transfer inflation forecasts haven't materialized as quickly as some people thought is because we're getting to the point where this is actually somewhat stimulative, and it's offsetting some of its own effects. So I think that in the near term, disinflation's winning, but slowly. And I think the bigger risk is that the longer this goes on, eventually the private sector kind of normalizes,
Mm.
whereas the public sector deficits are still there. And then I think we get another wave of inflation in the years ahead. And that'll depend on various factors. Basically, I think the next time we have a growth phase, so the next time we have rising PMIs, rising economic indicators, things like that, I think there's a good chance that inflation would return with it. Um, and so I think the kind of the base case I'm looking at this decade is higher average inflation. Now, whether or not we get up to another period of like 9% is unclear because
Mm.
that was like 15% deficits, and injected kind of right into the middle of the economy. Whereas I think what we could experience is a longer and grindier type of inflation. Now, obviously, things like acute energy shortages or war or, you know, tail risks can always give you crazy numbers. But
Yeah.
in general, I think the theme we're looking at is higher deficits, and then structurally deficit-driven inflation, kind of throughout the developed world, and especially kind of centered around the United States, in the decades that follow.
Can you just give us a little bit of a history lesson on what the inflationary forces looked like back then, how the US responded, and how that situation ultimately ended up resolving itself?
Sure. So, and I've used the 40s comparison a lot for the 2020s. And
Yeah,
when I point out what Druckenmiller said in the article, it's funny because I caveated that with saying like I
you
don't really
did.
like
Yeah, you
I
did.
don't like to critique the Grandmaster.
Yeah.
But it's just a fact. It's just something that whatever data set he was looking at probably didn't go back that far. Um, and so in the 1940s, well, let's go back to the 30s. So in the 30s, you had the Great Depression, you had rising populism, frustrations, in the U.S. and around the world. Um, uh, that almost in many ways directly fed into the conflict that happened, that followed in the late 30s and into the 40s. And during World War II, you had obviously massive fiscal spending, just absolutely enormous as a percentage of the economy. And although a lot of that was spent for, and really a lot of it gets cycled back, you're paying, soldiers. It's kind of like a jobs program. You're building manufacturing facilities. You're getting commodity, production online. When those soldiers came home, they put 8 million of them through technical school and college. They gave them mortgage assistance, things like that. And part of what they were trying to do was, in World War I, when soldiers came back, they just kind of gave them a bus ticket and said, "Thanks for serving your country." And one of the issues during that era is that you had the rise of the Soviet Union, and you had in the United States, you had some communist sympathies. That people were saying maybe that is a better model. And it's like, look how they treat us. And it's like, so one thing that the West did was try to say, okay, we'll go 10% of the way there. We'll fix some of the imbalances. We're not going to go full communist. So it's like, okay, let's do these kind of programs, right? We're gonna this time when soldiers come back, we're gonna make sure that they're brought into the economy better, kind of things like that. Um, and so you had a very rapid, very large deficit, very rapid money supply growth, and then, as one would expect, very rapid inflation. And again, it wasn't caused by bank lending. Banks were barely lending. It was almost all fiscal deficits, and it was monetized by the Federal Reserve. They didn't call it QE, but it was QE. They were creating new bank reserves to buy bonds. And back then, the Fed was captured by the Treasury. So the Fed didn't really like it, but they were told, look, that you have to fund the war. And so basically they did yield curve control, kind of like what Japan's doing today, where
Yeah.
right now, Japan has inflation above their target, but they're still holding rates, in that spectrum around zero. Back then, the United States would hold short duration rates at just over zero, and they held long duration rates at 2.5%. And the way that the mechanism that they did that was they say any bond that tries to trade over 2.5%, or put another way, if it trades below a certain price, we have an open bid to buy that. Um, and so they had this kind of like low artificial but positive yield curve submerged below the inflation rate. So you'd have inflation spike up to 19%, and that whole short-term and long-term interest rate complex was just locked there. And so if you held cash or bonds, you just got killed on a real basis. You basically it was kind of like classic inflating the debt away. And after the war, they pivoted towards austerity. They had, the demographics were very different. You had tons of workers for every retiree. You had a very unified economy, like a unified population, like a lot of kind of we're in this together type of mentality. And so you had a very productive period, as some of those war funding stuff was kind of repurposed towards domestic manufacturing. And they pivoted towards austerity. And so the primary way to get inflation down was to stop the source of inflation, which was the large fiscal deficit. So they by essentially defaulting on part of that debt through inflation, and then by directly tackling the cause, the deficit, they managed to enter this kind of next period. And I think the challenge now is that we have, in some ways, a similar but less extreme scenario, with the difference being that there's no end in sight this time. It's demographics driven, it's top heavy age population. The United States has like our healthcare costs per capita are like 2.5 times what Japan's is, even though Japan's on average 10 years older. So when you add military spending, Social Security, Medicare, and just the overall demographics picture combined with our tax structure, we just have just these structurally large deficits that are just going to continue for no end in sight unless it's reformed. And that is money that's is just going to keep pouring into the economy.
So, you mentioned that you took a lot of inspiration from the 1940s, and you can certainly see some of the similarities just in terms of fiscal policy. And then I guess negative real interest rates are the other similarities. So, do you predict that out into the future over a period of time? And then what are the consequences if that ends up being the case?
So I think in general, we are going to see on average negative real rates this decade. Now, right now, we're in a period of trying to be as hawkish as possible.
Hmm.
So you can certainly you can get positive real rates for a period of time. But when you just run the math for how much debt there is compared to the size of the economy, it's very hard or impossible to make that work on structurally positive real rates.
Hmm.
I think one way of thinking about it is that, if you run the numbers just as on the U.S., so what is debt relative to revenue? What is debt relative to income? I mean, income's negative because you're running deficits. Um, you do all the numbers, and it's an uninvestable company. If it was a company, it's like below junk. And so that debt has to default in one way or another, and the question is how. And if you control your own currency, you're very unlikely to default nominally, and so instead you default through money printing. And so I think the general trend we're going to see is, in the near term, I mean, I like cash equivalents. I mean, if you can get 5% on T-bills and money markets, I mean, that's pretty attractive.
I know. Yeah.
But I think on average this decade, basically I think rates are going to spend most of their time not really keeping up with inflation, and certainly not keeping up with like true inflation, right? So when you look at, inflation over the past, let's call it 100 years, you have a number for CPI, but that number is kind of always resetting towards slightly lower end goods. Like if ribeyes get expensive, people stop buying ribeye, they buy ground beef, and then the thing adjusts downward towards that new reality. And so if you kind of break it into categories, like fine art and waterfront property, that increases roughly at the rate of money supply growth, because you have this finite asset that you can't make more of, and money supply is growing, and it's almost a one-to-one correlation over a long enough stretch of time to take into account volatility. And then below that, you have things that are pretty energy intensive, things like gold or oil or beef. those things are generally increasing higher than the rate of CPI over a multi-decade time frame, because they're not quite as fast as the money supply growth, because we are getting somewhat better at making them. We have better techniques for getting gold. We have better techniques for getting oil, for getting cows, all that kind of stuff. But it's still quite energy intensive and labor intensive and all that. And then when you go down towards like the lower end stuff, I mean, you get electronics that's just outright deflationary. Textiles are deflationary. We have all these kind of things that we've gotten way better at making. Plastic toys. We have this kind of long tail of things that are really not scarce almost at all, and that's really dragged down our average CPI. And so when we look forward, I think that anything that has some degree of scarcity to it, is what you really want to look at for kind of the quote unquote true inflation rate. Is kind of that the top like half of the asset spectrum. Whereas of course, software, AI, all sorts of things are going to continue to make certain types of things